Hey there. Just when you thought it was safe to go back in the water, the Fed minutes came out and gave a warning that the bank issues from March and late February are likely to give us a recession later this year. Or to quote the famous philosopher Gilda Radner, it's always something. This is Randy Kirk. We're going to dive into all things financial today, including Tesla. And I think, if this is content that you like, on Wednesday, we do financial. On Sunday night, we do a financial. We call it Monday morning. You can check what I think is going to happen during the course of the upcoming week. And then on Friday night, we take a look at the week in review. So hit like, hit subscribe, hit notify if you'd like to be notified about those other financial times that I give some reporting on that aspect of everything. Okay, let's dig right in here. So I woke up this morning and I pulled out my iPhone, as I usually do. And on this particular day, I wanted to see, number one, I wanted to see the CPI. Well, it was a great surprise because the increase of month over month was only 1%. And I don't know how, the market could have been any happier, and the Fed should have been happy with that 1%. But then I checked the market, and guess what? It was kind of meh. It was up, and then it came back down, and then it was up. It was kind of mealy-mouthing around. It wasn't really that great a response to this, really, what I would consider to be really good news. Well, anyway, after going back and forth for a while, I kept on looking at the CPI reporting. Man, there's such limited reporting this particular time. Nobody was really analyzing or giving me anything to get my teeth into, but I took a look in detail, and the only thing that was really up over the 4%, which is the average over the last 12 months, the only thing that was really showing that it might still be contributing to those kind of inflation rates would be housing and travel, entertainment, food away from home. Those things I've been saying all along. I would consider that travel, entertainment, that category is going to continue to be an inflation issue. It is really disconnected from the rest of everything else. People still want to travel. They think they've got enough money, and lots of people do have plenty of money to do the travel that they want to do. So I would think this is not an area that's going to be helpful, maybe even all through the summer and into the fall. Housing, I was kind of surprised by this number because they're looking at both the rental rates, leasing rates, et cetera, and they're also looking at the rental equivalent rate for people that own. And based on everything I'm seeing is that housing, the retail value, the value that people are paying for homes, into single family homes, has been dropped about 15% so far this year. Now, maybe it's not continuing to drop, and maybe it's starting to inch back up. I've seen a little reporting in that area. So this is interesting. And also something I've been talking about now for 2 weeks is going into the spring season, there is no inventory, none. There's no inventory. So I don't know if housing can continue to be reducing and may really start to inch back up. And the current interest rates are not going to affect that situation any more than it already has. In other words, you've already had this trade-off of higher interest rates reducing what people can afford. That trade-off's already been made. Those prices have already dropped to fill in that blank. So now you're back down to supply demand and who needs to move. So I don't think that the current interest rates are going to slow down housing at all going into the spring. So we'll see what happens, but that would be my take. And it's also a lagging indicator, but again, I think we will see housing potentially inch back up, and I don't think there's anything the Fed can do about it. Quite frankly, I just don't think that's going to be as much as they'd like to. I think they want to also kill the housing market, but I don't think it's going to happen. So overall, I thought the CPI was excellent. And I think that we can get down to the 2%, except there's one thing that continues to bother me. I'm nervous about oil. Oil has popped back up over 80. Today it was at 83. I just looked in the aftermarket and it's still in the 83 area. I don't like that at all. And I think if oil continues to inch up and goes into the high 80s or into the 90s, this would be not good for our fight against inflation. And the Fed isn't going to not pay attention to that. So I'd really be watching out for that. I'd be obviously looking at the derivatives of that, what's happening to the price of electricity, what's happening in terms of for the upcoming summer for air conditioning and whatnot, and also what's happening to the price of gasoline at the pump. Now, overall, you'd think with all of the solar that's going in, with all of the wind energy that's going in, with all the people that are buying electric cars, you would think that there would be some additional supply for the overall energy market that would tend to drive oil down. But you also know that the OPEC nations dropped by 1.3 million barrels a day from the overall production. And so that is why the price jumped back up from the low 70s up into the low 80s. Okay, so I'm nervous about that. That's one thing that we still have to keep keep looking at. So anyway, the market was going along, like I say, kind of meh during the day. And then all of a sudden it started dropping like a rock. And I'm like, what the heck is going on now? It took me a couple of minutes to research it, but found out that the Fed in their letter, which I forgot that the Fed letter came out today, and in a letter from the March meeting, they said, oh, the SVB, no, I'm sorry, I'll get it in a second. Yeah, SVB, I had it right the first time. So the SVB bank failure and some of these other bank failures that have happened, there may be more coming, and the ones that have already happened could ripple through and cause a recession later this year. They said a mild recession. Well, the market never wants to hear about a mild recession, except of course, if you're trying to drive down inflation, which would be good. And then you get back to this as good, bad, and bad, good, or not. So, but the market apparently didn't like the idea that we might be looking at a mild recession. Now, how does that work? I was like a little confused about it myself. I did a bunch of research. So basically what they're saying is that the interest rates being high, the local regional banks maybe not having as much money to be able to lend because their deposits have gone to the bigger banks. All in all, what this might mean would be that small businesses or middle-sized businesses wouldn't have as much money to be able to do business. And if there's also a slowdown in the economy, then that's going to hurt on the revenue side. So you got the revenue being hurt, interest rates going up, so costs going up, no way to pass on those costs to the consumer. So your margins are going down, your overall margins are going down. So the whole thing is kind of a mess. And if you want to look at it from, it was either yesterday or the day before, John Gibbs, one of the authors of the Elon Musk message, I'm sorry, the Elon Musk mission, one of the authors of the Elon Musk mission. And if you haven't bought yours yet, you should buy your copy. John Gibbs did a nice video a couple of days ago where he talks about how, for instance, auto dealerships, the interest rate and the fees that they're paying to floor product, and this is, I think, both new and used. John was talking about new, but I think it applies to used as well, is that there's special rates that these folks get to floor vehicles, and they have 90 days to move them. After 90 days, it goes up even higher. Well, if the economy slows and people aren't buying as many cars, and now these people are already paying a higher rate to begin with, they're having to pay it over a longer period of time, and then they're having to potentially pay an even higher rate if the cars sit there for 90 days. This is going to hurt these companies badly. Well, some of the banks are going to say, I don't want that risk. So then they're going to say, I'm not going to loan to that group. And then all of a sudden those folks have to go find somebody else to borrow from. So you have this continuing problem. This may be the kind of thing the Fed is talking about. I certainly experienced it in my own businesses over the years, where in rough times like this, bankers start to go, nope, not going to loan, not going to loan. So we'll see what happens. All right. So that's why the stock market went down today, continued down. After the Fed letter came out, it just continued to go down all through the day. And yeah, so that would be the main factual information from today. I think the market is probably going to be over it by tomorrow. There's probably going to be a lot of bargains. People are going to be looking for opportunities to move back into the market. That's just my guess. So maybe tomorrow won't be as bad as today, or it might be even up tomorrow. How does Tesla fit into all of this? Well, of course, Tesla is still being judged as a growth stock with risk. No idea why, but they're still being judged, and they're in it category. Look at what happened to ARK K, ARK G, et cetera today, which that's what they specialize in. What ARK does is lots of risky growth stocks, where the idea is if 1 in 10 of them turn out to be a bonanza, then you score. It's like venture capital financing. but at the level of a Kathy Woods with a fund. So that's the theory. And Tesla is still being grouped just like them. On Twitter every day, I put out the end of the day what those companies like that, showing that their chart for the day is almost the same as Tesla's chart for the day. Sometimes Tesla's percentages might be higher or lower, but the chart is very, very similar. So that's how Tesla is still being viewed by the players. And you got to get, and that's just something we have to be used to until the world comes to the conclusion that Tesla is a blue chip or a very solid company that should be treated as not risky anymore. So that's really what we have to look at with regard to Tesla right now. I said at the beginning of the week, I think I even said last week, that I believe Tesla will continue to move along with that same group and more or less with the overall macro right into earnings day. I don't think there's going to be any information about Tesla between now and earnings day that would cause that to be any different. That's just my guess. I am not a financial advisor. This is for your entertainment value only. But what I'd like you to do is, if this information is helpful, useful, or even a little bit entertaining, join my Patreon and help support the channel. Buy the book, which also helps to support the channel. And then, hit the like button if this was useful. This has been Randy Kirk, and I just really enjoyed talking to you today.